Bitcoin has moved lower again, but the reason matters more than the price itself. This decline isn't driven by a single headline or one isolated event. It's the result of broader risk-off behavior across global markets. Equities are under pressure, especially in technology. Bond yields remain elevated. Liquidity conditions are tighter than they were during the last major rally. When capital becomes more expensive, speculative assets feel it first. Over the past weeks, Bitcoin has broken below several psychological levels. Not because the network changed, not because the protocol weakened, but because positioning changed. A large portion of recent demand came from momentum, leverage, and short-term expectations. As volatility increased, that leverage was forced out of the system. Liquidations don't care about long-term beliefs, they only respond to margin requirements. At the same time, ETF flows have slowed, not reversed completely, but paused. That matters because marginal buyers set short-term price direction. When inflows slow while sellers accelerate, price adjusts quickly. What's important is what hasn't changed. The Bitcoin network continues to operate normally. Hash rate remains historically high. Block production is stable. There is no technical failure behind this move. This is a market structure event, not a protocol event. Institutional behavior also shows a split. Some participants are reducing exposure to lower overall portfolio risk. Others are quietly accumulating at lower prices. This divergence is typical during corrective phases. Fear dominates headlines, but positioning data shows a different story. Long-term holders are not distributing aggressively. Coins continue to move off exchanges rather than onto them. That suggests selling pressure is concentrated in shorter-term hands. Historically, Bitcoin corrections become most violent when expectations reset. After strong upside, the market needs time to absorb prior gains. This doesn't mean price must immediately reverse. Markets can stay irrational longer than most expect. Sideways movement or further volatility is always possible. But structurally, this phase is about repricing risk, not abandoning the asset. Macro conditions still dominate the narrative. Liquidity expansion lifts all risk assets. Liquidity contraction compresses valuations. Bitcoin reacts to that environment like any other high beta asset, only faster. That speed creates opportunity, but it also amplifies emotion. For investors who relied on leverage, this drawdown feels catastrophic. For those with long time horizons and controlled position sizing, it's part of the cycle. Markets don't reward conviction alone, they reward patience, liquidity, and survival. The key question isn't whether Bitcoin goes up tomorrow or next week, it's whether the broader system forces capital back into risk or keeps it defensive. As long as liquidity remains constrained, volatility will remain elevated. When conditions ease, assets that were punished the most tend to respond first. Bitcoin has always moved ahead of narrative shifts, not after them. This phase will eventually be remembered not for the price, but how participants reacted under pressure.